everyone, welcome back to the show. Thanks for tuning in. My name is Mike. This is my whiteboard, and today we're going to be talking about expiration. Next week is expiration for a lot of different underlyings, but there's a lot of different days that is the last day that we can trade that specific underlying, which is somewhat new to some people, but maybe if you're trading VIX or SPX, you already know this. But I want to throw it out there just to make sure that everyone is on the same page for next week. So if we go to the next slide, we're going to talk about a few different things with expiration. So really, what happens when options are exercised or options are held through expiration? Well, there's really only two things that can happen. We can become long stock, or we can become short stock. Or if we have a spread, maybe we'll become long stock on one option and short stock on another, which totally wipes out the situation that we have there. But if we have just these options, I want to point out that if we have a long call, which gives us the right to buy 100 shares of stock at a certain expiration and certain strike price, then we're going to become long shares if this option is in the money. Now, when we're looking at different options, being in the money can mean different things, but really what we want to focus on is the intrinsic value. So with calls, being in the money is when we're below the stock price. So if the stock price is at 100 and I have a 90 call, that means that that call is in the money, and specifically it has 10 points of intrinsic value because it's 10 points in the money. And with a put, it's just the opposite. So intrinsic value is going to be seen on the upside. So if we have that same stock at 100 and I have a 110 put, then I have the right to sell my shares at 110, which is where that intrinsic value lies. So with puts, intrinsic value is above the stock price, and with calls, intrinsic value is below the stock price. So if we have a short put that's in the money, it's basically we're giving someone else the right to sell their shares to us, which ultimately results in long stock. So if we have a long call or a short put, if those are in the money and they're held through expiration, those will automatically be exercised into long shares. So if we know that's true, if we just take the opposite of that, so a long put and a short call, then that's what's going to result in short shares. So if I bought a put but I don't have the actual shares, then basically what will happen is I'll be short stock at that strike price because a put contract gives me the right to sell 100 shares of stock at that certain strike. So if I own this put and it's in the money and I don't have the shares, then what's going to happen is I'm still going to have to sell those shares. And since I have no shares right now, I'm going to be selling shares to the market, so I'm going to be short 100 shares of stock for every contract that I have. And just like the put, a short call is going to result in the same thing. If a call contract is the right to buy 100 shares and I sell that right to someone else, if I'm selling a call to someone else and that is in the money and exercised, now I am obligated to provide those shares to that person. So it's the same exact scenario. I would be left with short shares at expiration. But if an option is out of the money, which is exactly what we want to happen if we're selling options primarily, those are going to disappear from the account and we're not going to have to do anything because out of the money options have no intrinsic value. So calls that are above the stock price or puts that are below the stock price, both of those scenarios are out of the money, and at expiration, we know that if we know that stock is going to turn into, or these options are going to turn into either long or short stock, stock only has intrinsic value. Stock does not have extrinsic value. There can be speculation around where a stock price might go, but that doesn't affect the value of the stock. The value of the stock is what it is, and it's purely intrinsic value. So we know that if I have out of the money options, there's no intrinsic value, and therefore they must be worthless at expiration. So any out of the money options are going to disappear from the account, and any in the money options are either going to turn into long stock or short stock at expiration. But let's go on to the next slide and we'll talk about a few other things that we need to know when it comes to expiration itself. So there are actually two different expiration styles. So the majority of the underlyings that we trade are going to be American style, which basically means that we can exercise these early. So if you've ever had a short option that was in the money and it had barely any extrinsic value left, we might have been exercised early on that option. So what happens is we might get an email from the broker saying, hey, you've been exercised early on this option, so you no longer have that option. Now you either have short shares or long shares, depending on whether you've sold a put or sold a call. So when we're looking at American style options, they can be exercised early. And as I stated, usually when we're looking at the liquid equities that we trade, like Twitter, Google, Apple, you name it, any of those equities, they're going to be American style options. We do do have the right and the ability to be exercised early if we're holding those short options and they're in the money. People aren't going to exercise out of the money short options because there's no intrinsic value. There would be no reason to exercise that, so you'll never see that happen. But there also is another expiration style, which is called European style. And these options cannot be exercised early. So two of the most popular underlyings that we trade are SPX and VIX that apply to this. So when we're looking at SPX, for example, which is the cash settled index that tracks the S&P 500, these are European style options. So if I sold a put or sold a call and one of those options is deep in the money, I don't have to worry about early assignment because it cannot happen. These are European style options and they can only be exercised at expiration when the trading is over and we're prompted with that ability to exercise that option or not. So if I'm long a call or long a put, I'm going to be prompted to either exercise that or not. And if I'm short the option, if I don't want to deal with that, I would have to get out beforehand. And just like SPX, VIX is going to be the same thing. So VIX is the cash index as well that looks at the volatility of the S&P 500. So these are the two most popular European style options that we trade. There are some other ones, but these are the two that I wanted to point out. So let's go on to the next slide and we'll look at a few different things about SPX and settlement specifically. So when we got expiration times, we've got different types of expirations. We're going to be looking at AM settled and PM settled. So these are a few differences when we're looking at the difference between something like SPX and VIX and the rest of the equities. So AM settled expirations are the non-standard expirations. They're a little bit different and they're pretty unique in the way that they're handled. So when we're looking at AM settled expirations, they're settled in the morning. So the last day to trade it would be the previous day. So if I know that SPX is expiring in the AM on Friday, the last time I can trade it is before the close on Thursday because they're being settled in the morning where there can't be any trading happening on those options. So we really need to pay attention to those expirations. And another thing to point out is that SPX is going to settle to a different price. It's not going to settle to the closing price of Thursday's close. It's going to settle to set, which is the settlement price of the S&P 500. Basically, they take all of the S&P 500 underlyings in there, they look at the opening print, and they find the value based on that. So it really has nothing to do with the previous close of SPX. So it's a little bit unique, but if you missed my segment on SPX settlement, I have covered that in full. So definitely check that out. You can click on Find Shows at the top of the page and just go down to Mike and his whiteboard and you'll see it there. But another thing to note is that VIX is the very same way. So VIX isn't going to settle on the closing price of that expiration. It's going to settle to VRO. So it's really important to realize that these underlyings are settling to different things. They're not looking at that closing price, but they are both AM settled. PM settled is where we're going to see the majority of the things that we trade. So just like I said before, when we're looking at Apple or Google or Chipotle, all these things are PM settled. So they're settled after the close, which means the last day to trade it is the day of expiration. So if I was trading a weekly and it was expiring today, any of those underlyings I would still be able to trade up until 3 o'clock Central Time today. And again, it's usually these liquid equities that we trade. So a lot of the trades and a lot of the underlyings that we're trading are going to be in this PM settled category, but it is good to check just to make sure that we're not trading something that's AM settled so we don't get ourselves into a situation that we don't want to be. But I really want to hone in on the SPX and VIX underlying. So let's go on to the next slide and we'll do just that. So there's a few things I want to point out with trading SPX and VIX. So as I said, SPX settles to the set price. And with SPX, the monthly expiration is the third Friday of every month. So it's very similar to all of the other equities that we trade that are PM settled, where we're looking at the normal regular expiration as the third Friday of each month. But what's interesting about this is, again, this is AM settled. The regular monthly expiration for SPX is AM settled. So the last day to trade it would be Thursday. So next week is going to be the third Friday of the month. So the last day to trade any SPX position is going to be Thursday before the close of 3 p.m. Central Time. So I wanted to point that out, but it's really interesting because SPX actually has weekly options that are PM settled. So if I was trading SPX today, I can still trade SPX today because those weekly options are PM settled, but just that monthly expiration, so next Friday, is going to be the third Friday of the month, and therefore it's going to be that AM settlement. So this week I can trade it through today, but next week I'll have to close it before Friday morning if I wanted to actually get out of that position. With VIX, it's very much the same thing, but the day is actually different. So VIX is again going to settle to VRO, but the monthly expiration is the third Wednesday of the month. So it's not Friday like all the other underlyings, it's actually on Wednesday. So that means the last day to trade VIX next week is Tuesday. So we have to get out of our positions or roll our positions if we don't want to have those in the money exercise fees, or if we want to keep the dream alive if we see a losing position. We're going to have to do that trade by Tuesday at 3 p.m. So we need to really keep this in mind when we're trading underlyings like this. And it's really just points out that we might understand one thing, but it could be totally different. So let's wrap this all up with some takeaways for you. The very first takeaway is, again, it's important to understand what we're trading. I could be trading SPX and VIX and think that the expiration is on Friday and I can trade it all the way through the day next week, but it's very much not the case. So again, when we're looking at VIX, next week is the third Wednesday of every month, so the expiration is on Wednesday, but the last day to trade it is actually going to be on Tuesday. So if we've got any VIX positions, we'll either have to roll them or close out of them before then. And with SPX, next week is the monthly expiration. So if it's going to expire on Friday, but again, it is AM settled, so the last day to trade it next week is going to be Thursday. But all the other weekly expirations for XPX can actually be traded through Friday. So it's a little weird and a little complicated, but just remember that the third Friday of every month for SPX is going to be that AM settlement. And again, different products can have different rules. So some things might be triple leveraged or double leveraged, and they might have a negative drag, or they might have different days where they expire. So it's really important to just Google what we're trading. So if I'm looking at an underlying, I'm going to Google it and see what it's made up of so I can understand exactly what I'm trading. It's really important to do that just so that we can get ourselves out of those bad situations that we might put ourselves in just by not knowing what we're trading. And if we want to avoid all these things, amongst others like gamma risk when we're getting really close to expiration, we usually look to roll or close the trade 7 to 10 days prior, because if I'm rolling or closing 7 to 10 days prior, number one, I'm avoiding gamma risk, but number two, I'm also avoiding all of these expirations altogether. Because if I'm getting out of it or rolling it 7 days before, I don't have to worry about the last day I can trade it, like a Tuesday of VIX or Thursday of the regular settlement of SPX. So if we want to avoid just thinking about this altogether, we can do ourselves a favor and get out or roll 7 to 10 days before, which is usually what we tend to do anyways. But I wanted to point this out as next week is that expiration week Friday. So thanks so much for tuning in. My name is Mike. If you've got any questions or feedback, shoot me an email here, or you can follow me at Dojo. Stay tuned though, we got Jim Schultz coming up next, and have a great weekend.